Hey everyone, welcome back. So the markets, huh? Bit of a roller coaster ride lately, right? We hear you. That's why we're doing this deep dive. Going to unpack this recent downturn, what's really driving it, and what does it all mean for you? Let's get into it.
Absolutely. Let's break it down.
Okay, so one of the biggest headlines from our sources got to be that geopolitical situation. Iran's missile attack on Israel on September 30th. Talk about sending shockwaves, right?
Yeah, no kidding. Whenever something like this happens, and this is a big one, investors get jumpy. It's understandable, right? Uncertainty makes people nervous. Historically, we see this flight to safety pattern play out. Investors pulling back from risk, shifting towards those safer assets. Your gold, your U.S. treasuries, things like that.
Makes sense, like a security blanket. But looking at the bigger picture, it's not just the geopolitical stuff, is it? We've also got some economic data that's, well, let's just say it's not painting the rosiest picture. GDP growth slowing down to 1.2% in Q3. That's down from 2.1% the previous quarter. On top of that, we've got those pesky unemployment claims creeping upwards. So are these numbers a sign of something more serious, or is it just a blip on the radar? Help us make sense of it all.
Right. So GDP growth, think of it as the economy's report card. And a slowdown, well, it definitely raises some eyebrows. Now, couple that with those rising unemployment claims, more people losing jobs, and you can see why investors might be feeling a little uncertain. It all feeds into this sense of, what's coming next? And that uncertainty can definitely impact market movements.
Yeah, that what's next feeling can be a real nail biter. And of course, as if things weren't complicated enough, we've got that old foe rearing its head again, inflation. 4.5% year-over-year increase, according to the latest figures. The Fed's trying to tackle it with these interest rate hikes, but that's a whole other can of worms, isn't it?
It really is. It's a delicate balancing act. Think of it like this. The Fed's trying to walk a tightrope. On one side, you've got inflation they're trying to rein in. On the other side, you've got the potential for those interest rate hikes to actually slow down the economy too much. It's all interconnected, and the market, well, it doesn't like surprises.
And while the Fed's busy walking that tightrope, let's talk about how different sectors are being impacted by all this. Our sources seem to point to some potential bright spots, especially in the energy sector. What's the story there?
All right, so remember those rising oil prices we talked about. Part of that is driven by, you guessed it, those geopolitical tensions. But here's the thing. Higher oil prices, while maybe not so great for your gas bill, can actually be beneficial for companies in the energy sector. It's all about perspective.
Interesting. So one sector benefits while others not so much.
Well, it's all relative. The tech sector, for example, which has had a pretty good run lately, might face some headwinds. Economic uncertainty tends to make investors a little more cautious about growth stocks, and there's always that possibility of decreased consumer spending, which can impact tech companies.
Makes sense. And speaking of consumers, those consumer-facing businesses like retail and automotive, our sources suggest they might be in for a bit of a rough ride. Is it time to start tightening the purse strings?
Well, a little caution never hurts. When the economy feels uncertain, it's natural for people to be more mindful of their spending. But here's a tip. Within those consumer-facing sectors, keep an eye out for companies with strong brand loyalty and products that people rely on even when times are tough. Think essentials over luxury items.
Solid advice. So given everything we've discussed, what's the best strategy for navigating these choppy market waters? Our analysis highlights diversification as a key factor.
Absolutely. Think of your investment portfolio like a well-balanced breakfast. You wouldn't just eat cereal, right? You want some fruit, maybe some protein. Same goes for your investments. Diversifying across different asset classes, stocks, bonds, commodities, that's your recipe for a more resilient portfolio.
So not putting all our eggs in one basket.
Got it. And what about those safe haven assets we talked about earlier, the gold and U.S. treasuries? Could they be a good addition to the portfolio right now?
They certainly could. They might not be the most exciting investments, but sometimes boring is good, especially in a volatile market. Gold and U.S. treasuries have a history of holding their value relatively well when things get bumpy. Think of them as your financial shock absorbers.
Love that analogy. All right. As we wrap up, any final thoughts for our listeners as they navigate this, shall we say, dynamic market environment?
Remember, investing is a marathon, not a sprint. Don't let short-term market fluctuations derail your long-term goals. Tune out the noise, focus on your strategy, and remember that while the market can be unpredictable, history has shown that over the long term, it tends to trend upwards. Words of wisdom. Thanks for breaking it all down with us. Until next time, happy investing.